Hey everyone, welcome back. Today we're cracking open Andrew Craig's How to Own the World.
We're giving you the inside track on his financial wisdom so you can start building your own path to wealth.
And it's not about getting rich, quick schemes or anything like that, is it?
Not at all. Craig's philosophy is all about really understanding how money works and then making it work for you long term.
And a big part of that, which he really emphasizes right out of the gate, is this idea that if your money isn't outpacing inflation, you're actually losing ground.
Sadly, that's the reality for a lot of people, especially these days with prices going haywire.
It's a tough pill to swallow. It makes you realize that just earning a decent income might not be enough in the long run.
It's a wake-up call, for sure. In the UK, the average person is woefully unprepared for retirement financially. Their savings just don't stack up against the rising cost of living.
That's a scary thought. But it's not just about those rising prices we see every day, is it? Craig also talks about this thing called hidden inflation.
Right, hidden inflation. It's kind of sneaky how it affects us without us always noticing. Imagine a basket of, well, all the everyday things people buy. That's how they measure inflation.
Okay, so the price of that basket goes up over time. That's inflation, right?
Yeah, but hidden inflation is like they're messing with what's in the basket to make the price seem lower than it really is. Like with substitution, let's say the price of your favorite coffee skyrockets.
Ouch, I feel that.
Instead of admitting coffee's more expensive now, they might swap it out in the basket for a cheaper brand to make the overall increase look smaller.
So it's like saying, sure, the price of beef is through the roof, but people can just eat more chicken. It doesn't quite reflect the reality for people who actually like beef.
You've got it. Then there's geometric weighting, which is a whole other way of downplaying the impact of price hikes on the stuff we really need.
Like gas, for example.
Yeah.
It's been all over the news.
Exactly. Gas prices could double, but because it's just one thing in that whole basket of goods they use to measure inflation, its impact gets kind of diluted in the overall inflation rate they report.
That makes sense, but it doesn't make it any easier to fill up our tanks.
Yeah.
So, substitution and geometric weighting. What's the third way they might be masking the true cost of living?
That would be hedonic adjustment. This one gets a little complicated. It's like imagine your phone stays the same price year after year, but it has a better camera or more memory.
Right, that's usually how it goes with tech.
So they might actually adjust the price downwards in their inflation calculations because you're technically getting more for your money.
So even though it's the same price tag, it doesn't mean things haven't actually gotten more expensive overall.
That's the key point Craig's making. They might be fiddling with the numbers, making us feel like we're doing okay, but in reality, our money's not going as far as it used to.
It's like a financial illusion almost.
In a way, yeah. And that's dangerous because we need a clear picture of our finances to make smart decisions.
So this hidden inflation is like a hidden current working against us. We need to be aware of it to navigate effectively.
Exactly. And that's what's great about How to Own the World. It's not just about accepting the way things are. It's about understanding the game and finding ways to come out ahead.
So how do we go from understanding these financial headwinds, this hidden inflation, to actually making our money work for us? I mean, that's the goal, right?
Absolutely. And that's where things get really interesting in How to Own the World. Craig dives into how wealth is actually built, and it's not always what we think.
Okay, so spill the beans.
Yeah.
What's the secret sauce? How do people actually get rich?
Well, one of the biggest takeaways from the book is that most wealthy people, they don't get rich just from their salaries.
Yeah, that makes sense. There's only so much you can earn from a job, even a really good one.
Exactly. The real wealth comes from their investments. It's about putting your money to work, not just working for your money.
Investing. It sounds simple enough, but it can feel so intimidating, especially with all the jargon and the ups and downs of the market.
I hear you. And there's a lot of misinformation out there, too, like this idea that it's impossible to beat the market, that whole efficient market hypothesis.
Right, I've heard that one. It basically says that all information is already reflected in stock prices, so trying to outsmart everyone else is pointless.
Yeah, and Craig totally dismantles that theory. He argues that it's based on this flawed assumption that everyone has equal access to information and that everyone's making perfectly rational decisions all the time. And in the real world, we know that's just not how it works.
So it's not a level playing field.
Not at all. And that's where the concept of asymmetric information comes in. It means that some people naturally have more information than others, giving them an edge.
Asymmetric information. Okay, I'm intrigued. Tell me more.
Think about it. Someone who works in a specific industry, they're going to have insights into trends and opportunities that the average person wouldn't. Or someone with a vast network of contacts, they might catch wind of a hot new startup before it hits the mainstream.
So it's not just about being lucky. It's about having access to better information.
Exactly. It's about positioning yourself to make smarter decisions. Now, we can't all be industry insiders, but we can definitely up our game when it comes to financial literacy.
Okay, so knowledge is power, but where do we even start? Where do we go to access this kind of information?
Well, that's the beauty of it. There are tons of resources available these days, books, podcasts like this one, online courses. It's about being proactive and investing in your financial education.
So step one, don't be intimidated. Step two, start learning.
You got it. And step 3, understand the playing field. Before you even think about specific investments, you need to grasp the different asset classes and how they work.
Asset classes. Now, those sound a bit intimidating. What exactly are we talking about here?
Think of asset classes like different categories of investments, each with its own risk level and potential for returns.
So like different tools in a toolbox. You wouldn't use a hammer for every job, right?
Exactly. Let's start with the most basic one, something everyone's familiar with: cash.
Cash is king, as they say, right?
Well, it's definitely important. You need cash for everyday expenses, emergencies, that kind of thing. But the problem is with inflation and all, cash sitting in your account, it actually loses value over time.
Right, it's not exactly growing while it's just sitting there.
hmm
So we need to make that cash work harder for us. What about property? That seems to be a popular choice, especially here in the UK.
Yeah, property can be a good investment for sure. You can earn rental income, and hopefully the value of the property goes up over time, but it does come with its own set of challenges.
Like what?
Well, first off, you usually need a hefty chunk of money up front to get started. And the property market can be a bit unpredictable, right? Prices go up, prices go down. It's a bit of a roller coaster sometimes.
Not as straightforward as it might seem at first glance. So property, potentially rewarding, but definitely not without its risks. Okay, what about bonds? Those seem to be a popular choice, especially for people who are maybe a bit more risk averse.
Yeah, bonds are often seen as a safer bet compared to something like stocks. With a bond, you're essentially loaning money to a government or a company.
And they pay you interest on that loan.
That's the idea. But it's not entirely risk-free. The value of bonds can fluctuate too, especially when interest rates change.
Okay, so even with bonds, you need to be savvy about timing and market conditions. It seems like there's always a trade-off. What about shares? Or stocks, as they're called in the US? I feel like those are the ones that get all the attention, but they also seem the most daunting.
Shares, yeah, they can be a bit volatile, that's for sure. But they also offer the potential for much higher returns compared to bonds. When you buy shares in a company, you're essentially becoming a part owner.
So you're betting on the success of that company.
Exactly. If the company does well, their share price goes up and you make a profit. But of course, the opposite is also true.
Higher risk, higher reward. It's a classic equation. Now, you mentioned funds earlier. How do those fit into the picture? They seem to be gaining popularity.
Funds are a great way to diversify your investments. Basically, it's like a big pool of money that's managed by professionals.
Professionals, so we don't have to pick and choose individual stocks ourselves.
Exactly. They do the heavy lifting for you. They'll take your money, along with money from other investors, and spread it across a whole bunch of different assets: stocks, bonds, maybe even real estate.
So it's a way to spread your risk, to not put all your eggs in one basket, as they say.
Precisely. Diversification is key, and funds make that much easier, especially for people who are just starting out. And then, last but not least, we have commodities.
Commodities like gold.
Gold is a big one, yep. But it also includes things like oil, natural gas, agricultural products, basically raw materials.
So why would you invest in those?
Well, commodities can be a good hedge against inflation. When the cost of living goes up, the price of these raw materials tends to rise as well.
So it's like a way to protect your purchasing power.
You got it. Now, having a grasp of these different asset classes is the foundation. But how do we actually put them all together into a solid investment strategy? That's where Craig's advice in How to Own the World really comes in handy.
All right, let's dive into that. Give us the breakdown. What's Craig's secret sauce when it comes to building a portfolio that can weather the storms and come out ahead?
He calls it the 3-bucket strategy. It's all about allocating your investable assets into 3 main buckets, each with a specific purpose.
3 buckets. I like it. Simple and memorable. All right, what goes in the first bucket?
This is your owning the world bucket. It's the biggest chunk of your portfolio, somewhere between 60% and 70%.
That's a sizable chunk. What do we put in there?
This bucket is all about global diversification. Think a mix of stocks and bonds from all over the world.
Why global? Why not just stick with what we know here?
Because spreading your investments across different countries and different sectors helps to manage risk. It's like if one market takes a hit, you've got other investments to cushion the blow.
Makes sense. Don't put all your eggs in one basket, right? Spread that risk around. So that's bucket number one, owning the world. What's next?
Bucket number two is all about owning inflation, which we were talking about earlier.
Right, that sneaky beast that eats away at our savings. How do we fight back?
Craig recommends allocating about 20% to 30% of your portfolio to assets that tend to do well during inflationary periods.
So things like commodities.
You got it. Especially precious metals like gold.
Gold. It's like the OG inflation hedge.
Yeah.
So first bucket, we're growing our wealth globally. Second bucket, we're protecting it from inflation. What's the final piece of the puzzle?
The final bucket is your cash reserve. This one's smaller, about 10% of your portfolio.
Okay, so even though we want our money to be working hard for us, it's still important to have some readily available.
Absolutely. This is your emergency fund, your rainy day money. It gives you peace of mind and flexibility.
Makes sense. So that's the basic framework, the three buckets. But how to own the world goes deeper than that, right? There are more nuggets of wisdom in there to help us on our investing journey.
Oh, absolutely. Craig talks about the power of compounding, for example. It's like a snowball effect. The longer you invest, the more your returns start to generate even more returns. It's pretty incredible, actually.
They're like magic, but with money.
Exactly. And he also gets into some more advanced stuff like fundamental analysis. This is where you really start looking under the hood of companies to understand their financial health.
So it's not just about following the hype. It's about doing your homework and understanding the businesses you're investing in.
Exactly. And for anyone who's interested in real estate, there are practical tips in there too, like how to calculate rental yield.
So whether you're just dipping your toes into the investing pool or you're already a seasoned pro, there's something in how to own the world for everyone.
For sure. And I think one of the most valuable things Crick emphasizes is that it's a journey, not a get-rich-quick scheme. It takes time, patience, and a willingness to learn and adapt.
It's about taking control of your financial future, step by step. Well, on that note, we've reached the end of our deep dive into How to Own the World by Andrew Craig. Hopefully you're feeling inspired and empowered to take charge of your finances. Remember, knowledge is power, and the first step is always the hardest. What will your first step be? Until next time, keep learning, keep growing, and keep reaching for your financial goals.